460 days. That's the average time Rams are sitting on dealership lots before they sell. And if you think that's bad, wait till you find out what other disappointing outcomes are out there in the car market after watching this video. Let's get into it. Consider this. Tundras are taking over 220 days to sell. Tacomas, once the king of resale value, are sitting for 150 days. Even Ford Broncos, a vehicle that people were paying above MSRP for just 2 years ago, are now gathering dust. Non-Raptor trims, 180 to 220 days. Raptor trims are doing slightly better at 80 to 100 days, but still far from the turnover dealers need to stay profitable. These numbers are shocking. Let's rewind for a second. Remember the craze for Tacomas back in the mid-2010s? You'd see posts all over forums about people paying thousands above MSRP to get their hands on one. Ford Broncos had year-long waiting lists, with buyers flipping them for profits on delivery day. So, what has changed? The answer is simple. People are tapped out financially. The financial landscape for the average consumer has deteriorated drastically. The national average negative equity is $7,200. What does that mean? It means many Americans owe significantly more on their cars than those cars are worth. Combine that with the average credit card debt of $7,236, a figure that continues to rise every quarter, and you've got a consumer base struggling to keep its head above water. For example, let's say you bought a $50,000 vehicle in 2020 at a low interest rate. Fast forward to today, and that same vehicle is worth $38,000, but you still owe 45 grand. Trading it in or selling it privately isn't an option because you'd have to cover the difference. And if you're in that situation, you are not alone. This is the sad reality for millions of Americans. Now let's talk about the sticker shock that's been hitting buyers for the past 5 years. MSRPs are up 42% across the board. That's right, 42%. And Jeep, they're an even more extreme example, with prices rising above 50%. Think back to 2018. You could get a base model Jeep Wrangler Sport for around $35,000. But today, you're looking at a price tag close to $55,000 for the same trim, even before vehicle add-ons and markups. Stellantis, Jeep's parent company, is feeling the consequences. Their stock has dropped more than 50% this year. And let's not forget, Stellantis' CEO resigned recently, likely to avoid delivering the grim news about what's coming for the auto market in 2025. And Stellantis isn't alone. Nissan's CFO recently stepped down, marking another red flag. The automaker has announced 9,000 layoffs worldwide. Ford, a household name, is cutting over 4,000 jobs globally. Volkswagen isn't immune either, with 3,000 jobs being cut this year alone, and plans to slash more than 35,000 jobs by the year 2030. These aren't just numbers on a spreadsheet. These are people, families, facing uncertain futures. Take Detroit, for instance, where the automotive industry forms the backbone of the local economy. Thousands of auto workers in the city have already been laid off. When those paychecks stop, it's not just the workers who feel the impact. Local businesses, restaurants, stores, and service staff suffered too. It's a ripple effect that haunts entire communities. And let's not overlook the suppliers. Michelin, one of the largest tire manufacturers, is cutting 1,250 jobs. In Alabama, the Pell City Auto Parts plant is laying off over 140 employees. These cuts may seem small in isolation, but they're part of a larger trend. Shrinking production means fewer jobs, and fewer jobs means less spending in local economies. It's a vicious cycle hitting auto-dependent regions the hardest. Now, let's pivot to the dealerships themselves. They're literally in crisis mode. Many are sitting on inventory they simply can't move. Imagine being a dealership owner with millions of dollars tied up in vehicles that aren't selling. It's a nightmare scenario. Shareholders are demanding answers, and manufacturers are still flooding lots with more inventory, hoping things will turn around. But here's the reality. Buyers are walking away. 23% more auto loans were denied last quarter compared to the one before it. The average monthly payment for a new vehicle is now $760. For used cars, it's $525. For many people, these numbers are simply unsustainable. And then there are interest rates. On new cars, they've climbed to 7%. On used vehicles, they're even worse, at 11%. That's a far cry from the 2 to 3% rates we saw just a few years ago. Insurance premiums have also skyrocketed, more than doubling in the last 2.5 years. For example, a family paying $1,200 a year for car insurance in 2020 might now be paying $2,500 or more. These rising costs are making car ownership increasingly out of reach for the average American. So what does the auto industry crash really look like? It's not what most people imagine. Dealerships handing out cars for free. Instead, dealerships are slashing prices by 10 to 20% below invoice just to avoid bankruptcy. Those who refuse to adapt will close their doors, returning unsold inventory back to the manufacturers. Take Rivian and Lucid as cautionary tales. Both were hyped as game changers in the EV market, but their stock performances say otherwise. Rivian has seen a 55% drop in share price this year. Lucid isn't far behind, with a 48% loss. Even legacy automakers like Ford aren't immune. Their electric Mach-E Mustangs and F-150 Lightnings are sitting unsold, even with hefty incentives. There is a silver lining though. High-end models like Toyota's TRD Pro trims, Ram TRXs, and Ford F-150 Raptors are finally being discontinued. And for the first time in years, vehicles like the Civic Type R are selling at or below MSRP. If you've been waiting to buy a car, now might be the time. But let's be clear, a market crash isn't just about deals. It's about the consequences for businesses, workers, and families. The auto industry isn't at a crossroads, and how it adapts will determine its future. The bottom line, the auto industry in 2025 is facing a reckoning. Years of greed, inflated pricing, and unsustainable practices have led us here. But what do you think? Is this a necessary reset, or are we heading for a disaster? Share your thoughts in the comments, and don't forget to like, share, and subscribe for more insights on the ever-changing automotive world. This has been Faris from Fender Benders, and I'll see you on the next one.